What is going on, everybody? Thank you so much for tuning into this course. This is episode 1 of the Forex Bootcamp provided by FFT Trading. This course is designed to take you guys who have absolutely zero experience in trading to being able to go and place your own trades at the end of it. Now, there's two things you've got to be aware of. Number one is that I'm a specific Forex and commodities trader. I am not proficient in stock or crypto trading or any other trading for that matter. And if you want to learn my methods and how I trade Forex and commodities, that's going to be a whole different thing entirely. But what I'm going to do in this course is specifically focus on foreign exchange, okay, specifically why I've called it the Forex Bootcamp. This also applies to gold as well. You'll see how gold and oil is also very closely linked to foreign exchange. But another part of this whole series is that it's not me teaching you my strategy, it's not me teaching you my approach, it's me giving you the tools to become a trader. And you're not going to be completely successful at it right from the bat. Absolutely not. But what I can guarantee you guys is that if you stick with this, you do your own learning, which I'll be guiding you through to go and research at the end of every single video. You're being very mindful about the things that you're learning. You're being very practical with it. At the end of it, you will be able to go to any price chart and be able to plot levels, be able to make some kind of hypothesis, and you will at least start to gain the knowledge in how to place your own trades. You're not going to be an absolute expert, but I promise you, you are going to be springboarded, right, into being able to have a great understanding of how to place trades. It's that simple. But without further ado, let's get cracking. So in today's section, what are you going to learn? We're going to talk about what trading is, and then specifically what is Forex. We're going to look at why people trade, the benefits of trading, and the risks involved. The most overlooked aspect and is the most important aspect, the risks. Okay, so what is trading and what is Forex? Okay, so trading specifically is where you're going to be buying and selling something for a profit. Now, a lot of people think that when we talk about buying and selling, we are always talking about buying our product or our service or whatever it is, our asset, and then we are going to sell it for a higher price. Now, for those of you that are a bit confused on the business terminology, an asset is simply something that will be able to give you money if you sell it. So in business, if you have, for example, machinery, that is something that is an asset because it generates money. In trading, there are different asset classes. Asset classes are things like stocks, commodities, foreign exchange. Another asset class would be cryptocurrency. That could kind of come under Forex, but you get what I'm saying. So every asset class is different. Okay, so we are specifically trading Forex and commodities. Okay, if you need to go and rewatch the video, that part, it's a bit confusing, go ahead. Okay, but the thing is with trading, we make money when prices go up and down. Okay, so when you hear me talking about, oh, I'm buying GBP USD or, oh, I'm selling gold, I'm not specifically talking about I'm buying GBP USD right now and then, oh, I've already bought gold and now I'm going to sell it for a higher price. No, you need to understand what long positions are and short positions are. And in trading, when someone is buying, they are expecting to make money when prices rise. This is what is called a long position. And in selling, we are expected to make money when price goes down. Yes, you heard that correctly. We can make money when the prices are dropping. And these are called short positions. Now, in foreign exchange and stocks, short selling is a little bit different. To be honest with you, I'm not 100% certain on the Forex side of how it works because it's all to do with brokers and, we'll talk about it in a little bit. But let me just give you a simple example as to how you can understand short selling from a stock trading perspective. Okay, assume now that you see Apple stock is trading for $10 and you think to yourself, I think that stock price is going to drop. And I think it's going to drop a considerable amount to $1, right? Because you've expected some crazy news event to come out, or you've been reading a bunch of, you've been a very diligent student. Couldn't even get my words out there. And what you do is you will approach the broker and say, hey, that stock looks very nice, that Apple stock. Do you mind if I borrow it? He will say, okay, go ahead and do that. Okay, obviously this isn't really how it goes. I'm just giving you the paraphrasing. You're not going to go online now, start emailing. It's all very electronic and you don't need to know this information to put the trades on. But let's just give you the context. So you take the Apple stock, he lets you borrow it, you sell it on the open market for $10. Surprise, surprise, the CEO is caught in a massive scandal just as you predicted, and now the stock price of Apple has tanked to $1. So you go ahead and take that $10 that you made, you buy it back for $1. You've got a nice £9 profit in your pocket now because you're going to go back to the broker. He's happy because you've given him his Apple stock back and you've made a successful trade. Fantastic. Okay. In currencies is a little bit more confusing and I'll probably go over it later on in this video. But for now, all you need to know is that we are expecting prices to rise, so therefore we are buying. These are called long positions. We are expecting prices to drop, so therefore we are selling, and these are called short positions. So just to put it in really simple terms, a long position is where you buy and sell later for a profit. A short position is where you sell now and buy back later for a profit. It cannot get as simple as that. And for those of you that are a bit confused as to what Forex is short for foreign exchange, foreign currency. And the reason why they call it exchange is because you will be exchanging different currencies, okay, to make a profit, right? How many of you have gone on holiday? I'm pretty sure that every single person watching this video has been on holiday. And if you're a little child, or if you're a grown up, you would know that you've seen mum or dad or you yourself have gone to the Bureau de Change or the airport or the bank and you've wanted to convert your pounds, your dollars, your whatever currency that you currently have in your country for the country that you're visiting's currency. Country currency, I was getting bloody hell, bit of a mouthful, eh? But that's how it works. For example, you are a British man and you are now going to go to the United States. So you need to go and purchase United States dollar. So you will go to the Bureau de Change and you will look for GBP USD and you will find the exchange rate. And the exchange rate will look something like this, 1.25. Okay, so this means for every pound that you spend, you are going to get $1.25. Okay, it's very, very simple. But you guys have never probably heard of base currencies and quote currencies before. Well, I'll break it down for you extremely simply. Whenever you see currency exchanges, like the exchange rate, they are always depicted by the currencies. So you may see something like GBP USD, USD JPY. You may see something like USD CHF. Okay, the currency is denoted by the 3 letters, and it's followed by the other currency, which is denoted by 3 letters. It always follows this. The first 3 letters are called the base currency. And the second set of letters is called the quote currency. And the exchange rate that you look at, it doesn't matter if it's 1.2, 1.3, 1.5 million, I don't care. 1 unit of the base currency will always equal whatever the exchange rate is in relation to the quote currency. Does that make sense? So if pound USD for whatever reason was 0.90, the base currency is GBP. The quote currency is USD. So therefore, 1 unit of the base currency, which is 1 Great British pound, will get you $0.9, if that makes sense. Let's go on to the next bit and you'll probably understand it a little bit more. But if this didn't make sense for you, recap, take some notes, and then go on to the next part. Okay, so as you're dealing with Forex, you are going to need to be aware of the 8 major currencies. They're called the 8 major currencies because these are the 8 major currencies that are traded globally, right? If you guys don't know, foreign exchange is a $3 or $5 trillion transaction day business every day. $3 to $5 trillion is traded every single day. And we'll talk about who those players are. But you need to understand what these currencies are because you're probably most likely going to be trading these currencies with each other. Let's look at them together. GBP is Great British Pound. USD is United States dollar. AUD is the Australian dollar. NZD is New Zealand dollar. CHF is the Swiss franc. JPY is the Japanese yen. CAD, Canadian dollar. And EUR is the euro. Okay, very, very simple. You'll get very familiar with this as you go on. So let's take a look at the right-hand side. Okay, any of these currencies can be paired up with each other, and every single exchange will have an exchange rate. Doesn't matter if it's GBP AUD, doesn't matter if it's USD CHF, doesn't matter if it's CHF GBP, doesn't matter if it's CAD AUD. It does not matter. There will always be an exchange rate, and the exchange rate changes every single day. Okay, so let's practice that base currency, quote currency stuff. Remember, first 3 letters is the base currency, The second three letters is the quote currency. Whatever the exchange rate is showing you, that means 1 unit of the quote currency will give you whatever the exchange rate is showing you of the, sorry, let me start that again. The exchange rate will always show you what 1 unit of the base currency can purchase of the quote currency. So if we have GBP AUD, it means £1 will give you $1 and 23 cents. If we have NZD USD as 0.8339, it means 1 New Zealand dollar will get you $0.8339 US dollars. If we have USD CHF 0.9837, it means that 1 United States dollar will get you 0.9837 Swiss francs. And the last one is that if we had Euro JPY 117.198, it means that 1 euro will get you 117.198 Japanese yen. Now, this can be a little bit confusing, but trust me, it's very simple. But the truth is, you don't really need to know the ins and outs of it like this. This is just so that you're clued up, you're understood, and you're familiar with the terms. Next part. So why do people trade? Well, one of the biggest reasons why people trade and decide to specifically trade for themselves rather than working for an institution or a hedge fund or a central bank is because they can make money anywhere in the world. The people who are just like me and you, the average Joe at their trading desk, logging into their trading account, trading here, trading there, trading here and everywhere, are what's called retail traders. And it's very appealing to the random, person who's in a day job to want to trade Forex or trade stocks because they can go anywhere and make money. All you need is an internet connection and a laptop or a phone, and you can simply make money. It's also a very lucrative business. You can make big money in this business, right? Genuinely, you can make big money, okay? And that can excite people. The thought of being international, the thought of traveling, the thought of working with international currencies and commodities, heck, I love that. That's what I love studying about. I found it so interesting how currencies affected the world and how world events affected currencies. It's so interesting to me. People also do it for a bit of side money. Maybe you don't want to spend all your time at the charts. You don't want to be a full-time trader, but you want to try to make a little extra cash on the side. I mean, you want to make a little bit on a Monday, a little bit on a Tuesday, maybe a big bit on a Friday, but just a bit of side money for yourself. You prefer your day job. You prefer getting nagged at by your wife 24/7 because you're spending too much, whatever. I don't know where the hell I was going with that. But yeah, bit of side money. Okay. And also the last point is the institutions. They like to trade Forex because these are the guys that are making either big money off it or they are working with the government. Okay. The central banks, if you guys don't know, every country has one, and it is essentially the government's bank, and it is their job to govern the financial system and the economy of whatever country we are in. So if you go to America, it's the Federal Reserve. If you come to Britain, it's the Bank of England. If you go to New Zealand, it'll probably be the New Zealand Bank, whatever they call it. I don't know. Okay, and they have a very pivotal job. They have a very important job, which means that they will be buying billions of certain currencies to maybe protect themselves against some storm. Maybe they have to purchase, lots of their own currency so that they can improve their exchange rate, whatever it is. Okay, investment banks and hedge funds are there to make big cash off it. Simply put. The risks involved. Okay, it can all sound very nice and appealing because we've heard about all the reasons why we should be trading, but let's look at the things that could actually cause you to be screwed over differently. Bend over backwards, put in a pretzel and chucked in the bin, and nobody even cares you lost all your money, because that can happen. You can quite simply lose every single penny that you have invested or you have made in your entire life. Now, I'm not saying this as it could happen. Oh, well, some of us who just become successful trading are just here because we avoided that pitfall. We just got over that hurdle. No, this happens only when people risk way too much. The good thing about trading is that you have every power within you to risk and lose only a certain amount. I've never been scammed, and I've only lost maybe a few $1,000s when I was trading when I first started. I know people who have lost thousands of dollars. There's a story of this very successful doctor in America who lost $750,000 trading. It's no joke. And the reason why people mess it up is because they're uninformed, they're not experienced, and their emotions kill them. This is one thing that you will learn massively, is that when you trade, your emotions are going to whip you around like you never believed. You're going to go from one side of the room feeling extremely ecstatic, you're going to get whipped over to the other side of the room feeling completely distraught in the matter of minutes when you first start out. It's very, very emotionally taxing, okay? The other side to this is that if you really want to learn, you're going to have to dedicate a portion of your time to it. Maybe if you want to go full time, you're going to have to stop drinking with the boys. You're going to want to dedicate your time to PlayStation, to studying. You really need to put in the time. Okay. Inexperience can also cause you to lose a bunch of money because you haven't spent enough time learning and being experienced in the market. So you need to have experience, you need your own experience, and if possible, get a mentor. Okay? Get a mentor, it'll help you out massively. And the last point is that people get sold dreams and get scammed like you would not believe. Yes, this is true about trading, and it's something that I really want to change the game about and change the stigma, because whenever people talk about trading or offering any kind of trading services, they always think of that guru who's got a Lambo and scammed them for hundreds of pounds, or the guys who are saying, yo, I'll teach you, all you got to do is just sign up to my course and invest $3,000. Nobody wants that. People want the genuine guys who are going to teach them, and that's hopefully what I'm going to give to you guys. But please be careful. If someone's showing you something and you don't want it, they're telling you have to invest, you don't have to do it. Anybody that's worth their salt will never tell you to invest money with them, unless you want to buy their courses, of course, fine. But purchase the education. But just to trade, you have to trade with this amount of money. You have to invest £300 with this. Most likely they have relationships with brokers. So they are telling you to invest that much, saying, you need $300, $400 just to give yourself a good head start. But really it's because their brokers are telling them that we're going to give you a certain fee of the money that gets deposited with the new customers that you bring us. So it's an affiliate scheme. Okay? And some of these guys can't even trade. So just be careful. Don't buy into something that seems too good to be true, because there are a lot of wolves in sheep clothing. All right, guys, that is it for the first session. Very nice introductory session, very informative, very good. Let's keep it calm, keep it simple. Go and watch the video again. Go and do, this is your time now for you to really get stuck in, do your own learning, look at some exchange rates, figure out some stuff that I haven't told you. This is something that you guys are going to have to be interested with. Obviously, you've clicked on this video because you've got an interest, but I want you to really, prepare yourself for the next bit. It's not going to be too crazy, but just make sure that you fully understood everything. And once you've fully understood everything, next video, we're going to talk about Forex analysis, not so much jumping into it, but we're just going to tell you about the types of analysis that traders use to compute and be able to place trades. So we're going to look at fundamental analysis. We're going to look at the factors that drive currency prices up. We're going to look at technical analysis and how to read charts. So that is just a little bit of a preview. That is essentially what it entails. There's two main types of Forex analysis: fundamental, which looks at economics and fundamental factors, and technical analysis, which is all to do with charts. But yeah, thank you very much for watching, all of you guys. Go and do some studying, and I can't wait to see you in the next video. Take care.